What's up, everyone? Welcome to the School of Personal Finance. So credit scores, credit reporting, all that stuff, it's so confusing. When you try to figure out what goes into your credit score and how to get your credit report and your credit score and all that stuff, you'll quickly realize that there's like a ton of information out there. But once you look behind the curtain, it's actually pretty simple. And getting a good credit score, it's not rocket science. So in this video, I'm going to teach you everything that you need to know to get a good credit score and to have a solid credit history, so you're always going to have favorable rates and credit available to you anytime you really need it. Let's get started. So your credit score, it's basically your entire financial history, all the debts and payments and everything that you've made over your entire existence, all summed up into this little 3-digit number that so much of the rest of your life depends on. So what makes a good credit score? I'm going to go through the 5 main factors that all have different weightings into what your credit score is. But before we do that, let's talk a little bit about why it's even important. Why does it matter? And the truth of it is, it has become very important in recent years. Like now, when you go to rent an apartment, they're going to pull your credit and see what your credit history is. When you apply for a job, before they hire you, they're going to pull your credit and see what your credit history is. If you want to lease a car, if you want to get a loan, a personal loan, if you apply for a credit card, if you apply for student loans, and ultimately, when you go to apply for a mortgage, your credit score makes a huge difference. So there are 3 different credit reporting agencies. There's Equifax, Experian, and TransUnion. And for some reason, each one has a different report for you and different scores, and not all lenders report to all 3 credit bureaus. So it's confusing because you have to check all 3 of them and make sure that they have correct information. And they're known for making mistakes. So you want to be sure that all of your info is correct. And you never know which one a bank is going to pull. So maybe some banks are going to use TransUnion and other ones are going to use Equifax. And when you're applying for a mortgage, they're probably going to pull all 3 of them, and maybe they'll take your middle score. So all this stuff is crazy, but don't worry about it. If you just follow the simple formula, you could have a great credit score all around and you don't have to worry about it. So what is considered a great score? Do you need to have an 800 credit score to be able to get the best rates and terms on loans and mortgages and everything? I think it's changed throughout the years. Like when I used to work in the bank, a long time ago, 700 seemed like to be considered, a very good score. It's gone up now. On recent mortgages that I've gotten on investment properties, 740 has been the number. If you're over 740, then on these mortgages, that's where you get the best rate and the best terms. It didn't matter if I had an 840 or a 740 for my FICO score. As long as I was over that 740 number, then I was going to get the best rate and terms. So in my opinion, that's what I would consider being, a great rate, 740 and above. But if you have 700, that's still a good credit score. I think that you want to be over a 700. That's a good place to be, and then continuing to build upwards from there. One thing that always surprised me were that people didn't really understand what does and what does not get reported to the credit reporting bureaus. So like, for example, when you pay your Verizon bill every month for your cable and Wi-Fi or whatever, that does not get reported to the credit reporting agencies. So you are not building credit by having cable in your house. But if you decide to stop paying it and they go to collection to try to get money from you, they will report that to the credit reporting bureaus, and it will kill your credit score. So you do have to be careful about collection. Even with medical, if you have a medical expense and it's $40 and you just ignore it, you're like, screw that, I'm not paying it. Then guess what? They're going to send it to a collection agency, and that is going to get reported on your credit report. But if you go to the doctor and they let you pay your bill over the next 6 or 7 months, they're not reporting that payment history to the credit reporting agency. So you're not getting credit for that. That's not building your credit score. Your rent is not getting reported to the credit reporting agencies. A lot of people think that it is. Things that will build your credit score are loans. When you borrow money to lease a car or to finance a car, or a personal loan, credit card payments. And you also want to make sure that they are getting reported if they're supposed to be. Sometimes the credit card companies might not even report it to the credit bureaus. So you want to make sure that you're getting credit for things that you're doing to build your credit score. So let's go through the 5 main factors that are used to come up with your FICO score. So now the first one is 35% of your score, and that is your payment history. And it makes sense. That should have the largest weighting because that's really the most important thing. Are you paying stuff on time? So now with the payment history, it's 30 days late. If you go past 30 days late, then they are going to report that to the bureaus and it is going to kill your score. So if you want to have a great credit score, the first thing you need to do is you need to pay your bills on time. Late payments, they stay on there for 7 years. So that is going to bring down your score for 7 years. It will kill your credit. You could drop 100 points like that by missing a payment by 30 days. And it could be a $3 payment. It really doesn't matter. It's going to ding your credit and it's going to bring your credit score down big time. So that's the number one factor. Stay on top of all this stuff. The second factor is what they call your utilization rate. And that makes up 30% of your credit score. So a simple example of utilization rate. Let's say that you have $10,000 of revolving credit available to you in a credit card. If you are using $5,000 of that, you're using half of it, then you have a 50% utilization rate. Now, most experts say that 30% is what you want to stay under. But if you want to have a great credit score, a credit score above 740, let's say, then you want to have like a 10% utilization rate. And now there's no exact science to this. So everything I'm saying to you is kind of theory, but that's what the experts say. That's kind of where you want to be. So 10% utilization rate if you want to have one of those scores up above 740. So the third factor, and this one has a 15% weighting, is your length of history. And that's pretty simple to understand. It's just how long you have had an established credit history. The longer the better. The fourth factor, which makes up 10%, is the types of accounts that you have. So they want to see a nice mix of, car loans, credit cards, maybe student loans, mortgages. The stronger mix you have, then the more creditworthy they think that you are. And then the last 10% is made up of new accounts and the number of inquiries that you've had. So if you have a lot of inquiries, a lot of people checking your credit in a short period of time, that's looked at as a negative. That looks like you're desperate for credit and that you're trying to get it from all these different places, and that will actually bring down your score. So 10% of your score is based on that. So now that we understand what goes into your FICO score, let's talk about ways that you could prevent your score from going down, some things you could do to make your score go up. First one I talked about already, and that's the 30-day late payments. You just have to be on top of the bills. It's one thing if you can't pay the bill, then your credit score should go down, right? You really shouldn't have a great credit score if you're that far extended that you can't make the payment on your bills, right? In that instance, the system is working. But to miss a payment, to go over 30 days late because you misplaced the bill or you forgot that you opened up this credit card, it's a silly mistake, and I've seen it so many times. So other silly mistakes that I've seen are co-signing for somebody. So at first, this might not seem like a silly mistake. Maybe a child, you decide, I'll co-sign on my kid's car loan with them. And then, what happens? They forget to make the payment and it kills your score. So you should never co-sign on any loan. It just always seems to have a bad ending to it. Another silly mistake that people make that hurts their credit score without them really realizing it is when they close an old established card that they had. If you have a bunch of cards that you've opened within the last year, and then you have one card that you've had for 20 years, they take the average of all those to get your length of history. So if you knock off that card that you've had for 20 years, now all of a sudden your length of history is only a year or so. That's going to kill your score. So old established cards that you've had, it's really never a good idea to close them. If they have an annual fee and you don't want to pay the annual fee, you're better off calling them up and seeing if you could downgrade that card to one that does not have an annual fee. And then the last silly mistake that I would see over and over again, and it would always surprise me, is if you're applying for a mortgage, if you're going to buy a home and you're going through the mortgage process, do not do anything else during that time period. Do not go lease a car, finance a car, open up a new credit card, co-sign on a loan. Don't do anything as you're going through the mortgage process, because once you do that, now you change your whole credit profile and it might kick you out of being approved for a mortgage. So if you're applying for a mortgage, put the brakes on everything else. Don't apply for credit anywhere until you have closed on that loan and you moved into the house. So if you're sitting there and you're saying, I've already had a bunch of late payments, my credit score sucks, what can I do to improve my credit score? There are a few strategies, a few things that you could do to try to improve your credit score. The problem is none of them are really guaranteed, but they're worth a shot to increase your score. So the first one is, we talked about utilization rate before, and that was the amount that you're borrowing compared to the amount that you have available. One thing that you could do to improve your utilization rate, well, the first thing is you could pay down some cards. That would be the best thing. But if you don't have the money to pay down the cards, you could apply for a new card and see if you could get a new card. And by doing that, don't use the card, but by doing that, you are increasing the availability that you have, and that will in turn improve your utilization rate. And then another strategy that you hear used to always work and now it's not working all the time, but it might be worth going for it. And this is good for somebody who's just starting out as well. And that's being added as an authorized user on somebody else's credit card. So a quick example, let's say that your parent has a great credit history, and they have credit cards that they don't really use that have very low utilization rates, very low balances. They could add you as an authorized user. So what they would do is call the credit card company, ask them to add you. They'd have to give your social security number because they want to make sure that it's going to get reported to the credit reporting bureaus. They add you, and now the whole history of that card would get added to your credit report. So in turn, in theory, that will automatically increase your credit score. So things to watch out for. If you're the parent in this situation, then don't send the child a card. All you're doing is adding them as an authorized user. So if you're the kid in this case, or if you're asking somebody else to add you as an authorized user, you're not doing it so you could spend their credit limit. You're just doing it to help the credits, to help your credit score, to get a boost in your credit score. But don't take possession of the card. Don't use the card. It's basically just to help your credit score. But that's a good strategy to be able to increase your credit score. Another way to give your credit score a little nudge that I just recently learned about is called Experian Boost. So this will only affect your Experian credit score. It won't help the TransUnion or the Equifax. But Experian has this program where you could sign up directly on their website, and it doesn't cost anything. And what you're doing is you're allowing them to scan your bank accounts for utility payments, for things that wouldn't normally count towards your credit score, that you wouldn't get credit for. And it will give you a little boost in your credit score. But it's worth just doing a little Google search. From what I read about it, it doesn't seem that there's really a downside to it, that most people that have done it, they have seen a little bit of an increase in their credit score, so it's worth a shot. So here are a few simple things that I recommend everybody do. Check all 3 of your credit reports at least once a year. You could go to annualcreditreport.com and get free reports there. You don't get the scores with it. You have to pay if you want the scores, but you could get the reports for free and just make sure that everything is on the up and up and that all your info is correct. The next thing is I would use an app like Credit Karma. That's the one that I've used. I've used it for, a decade now. And it's at, my thumbprint. I could go into the app. I could look at my credit scores. It sends me alerts anytime my score has changed. It's awesome. It gives you all the information that you could want. Another thing that I do is I do set up credit monitoring. Through credit cards now, a lot of them offer a free credit monitoring service. So if anything happens, you get alerted. And along with the credit cards, the other thing that I do is I get a text anytime any one of my credit cards gets used. So if I make a purchase, I immediately get a text. So it's just a way to stay on top of things and be alerted in case somebody got a hold of your information and somebody's, steals your credit card and is using it. So at the end of the day, there's really no shortcut with this stuff. If you're good with credit, if you're responsible with money and with your finances, you'll have a good credit score. If you're not responsible, if you're overextended, if you're borrowing too much money and you're in debt, you'll have a bad credit score. That's the way it's designed to work. All right, everybody, that is it for this one. Hopefully you found that useful. Please share this video with everybody because everybody needs to know this stuff. If you haven't already, hit that like button, subscribe to the YouTube channel, check out schoolofpersonalfinance.com, friend me on Facebook, LinkedIn, Instagram. You can follow me on there. I'd love to connect with you. Thanks so much for watching, and I'll talk to you soon. Thanks.